Hello, I'm Jon Ireland and welcome to the latest edition in Private Capital Pulse, brought to you by DLA Piper. Great to have you with us again. We're here, as you know, on Private Capital Pulse to talk to you about the stellar growth in private capital markets. Now measured in the trillions of dollars, private capital investors are actively pursuing yields and alternatives to traditional public markets. And what we're looking to do with the Private Capital Pulse episode is unpack some of the trends and analysis in this space, and with the benefit of insights from some of our DLA Piper experts and market leaders. And I'm very, very pleased today to be joined by Emma Kendall, who's a partner in our funds practice, and one of our tax partners, Eddie Ahn, to be talking all things ag. So agricultural investments is one of the array of asset classes now fitting into the private capital sphere. We're developing and increasingly seeing an institutionalized market in that space. And so very keen to hear from Eddie and Emma on the latest stuff going on in that market space. So Emma and Eddie, welcome.
Thanks, Jon.
Thank you.
Great to have you with us. Maybe to just kick things off, can I ask you, what are you seeing in the market generally in ag and ag investing? Maybe, Emma, if I could throw that to you in the first instance.
Yeah, well, Jon, it's certainly an interesting space and one which we're seeing a steady uptick in activity over the last 5+ years or more. I think it's an area which has traditionally been pretty hard for institutional capital to access, and we're seeing a bit of a turnaround in that regard. I think the market's sort of bifurcated, if you like, in terms of, well, maybe it's 3 channels deep. There's the traditional owners of agricultural land and businesses, which are the very much family-owned farmers holding the land and usually holding only one property. There's the smaller funds that are less aggregated and have maybe sometimes only a single property also, but which are raising private capital. And then at the other end of town, if you like, although it's the not town, there's the big aggregators that are bringing much larger portfolios to market. And so we're seeing a real sort of drive towards that large aggregation play. And I think the asset class is definitely, as it becomes more available, it's becoming increasingly attractive, because obviously institutional capital can't spend a lot of time trying to access really small investments. You know, they need to deploy big checks. These people have got, money to spend that rivals the GDP of small countries, and they've got to send it out the door. They can't be hunting small investments. So access and capital are kind of two intertwined things. So I think this big aggregation play is, the more it comes online, the more it comes online. It's a self-fulfilling prophecy. I also think the asset class is increasingly attractive because we live in a VUCA world, if I can use a bit of jargon there. It's volatile, uncertain, complex, and ambiguous, which Harvard Business Review recently summarized as being, hey, it's crazy out there. So I think the hey, it's crazy out there means, diversification is more and more attractive, and the institutional and high net worth market is increasingly seeking diversification. So these alternative non-correlated asset classes are running hot. I think the aphorism about not putting all your eggs in one basket is particularly apt for an ag investment class.
Yeah, that's interesting. I mean, it certainly seems that the asset class in and of itself is coming to the fore, possibly for, diversification opportunities, but that aggregation piece is very interesting too. It realizing the sector's value and sense in a portfolio for a very large global. And certainly we've seen instances of the offshore pension funds coming in and having a look at Australian assets there.
I think the sovereign, Australia's a pretty settled sovereign risk target for offshore capital. Eddie does a lot of offshore tax and inbound tax and outbound tax advice. Are you seeing that too, Eddie, the offshore capital coming in seeking this asset class?
Oh, definitely. And that was just the one thing I was going to add, was just to see the type of investors that we're seeing in this class. And I've definitely seen there's more appetite from foreign investors into this asset class. And a big part of it, Emma, is, as you said, it's just the diversification with perhaps some of the traditional real estate assets not being as favourable at this time, that foreign capital is still looking for a home in Australia. And so with a growing sort of ag fund sector, there is a growing foreign interest in this sector from what I've seen as well.
Yeah, I think there's a bit of an allocation sweep, isn't there, between office property, for example, is still weathering the storms of COVID and the switch away from office working. People are keeping their powder dry in terms of office allocation. And then infrastructure, traditional core plus infrastructure assets are kind of supply constrained. A lot of privatisations have swept through the market already, so that I think those two allocations are kind of pushing a bit more towards an ag allocation for these institutional capital.
Yeah, that's really an important point to see how this subclass, if you like, or specialist asset class, looks within a broader portfolio of real assets as an option, given that there is, whether it be a twin or multi-speed effect that's happening in that market space at the moment because of maybe geopolitical or macroeconomic issues at hand. Maybe, Eddie, just clicking to you on the investor perspective, which we sort of started unpacking there, how do you see the opportunities and challenges for a private capital investor, whether that be offshore or onshore? Possibly offshore might be facing a more complex environment than the onshore, but would you have any particular views from a tax perspective?
Sure. No, definitely there are some challenges from a tax perspective for foreign capital for this type of asset class. There have been some tightening of the tax concessions, especially for foreign sovereign wealth funds, for foreign pension funds, in funds generally. And so with that, we've been seeing a bit of a decrease in the size of the investment checks in order to now qualify for these new narrower concessions. But also in terms of administration, we're seeing fund managers requiring foreign investors who would normally have qualified for these exemptions, are requiring that they obtain a tax ruling from the ATO to provide certainty before the Australian fund manager will apply the 0% withholding tax. So in terms of also, not just decreasing the amount of their check size for investments, it's also increasing the amount of administration involved in terms of having to apply for tax rulings, getting external tax advice in order to obtain the exemptions that were previously much more simpler to obtain.
Yeah, on the administration side, though, I think we are, or at least we hope to see a decrease in the administration costs of ag-focused funds, partly because the tax benefits that the stapled structures and the old school bifurcated structure used to try and access have largely disappeared, which I think is, although we see a lot of those structures hanging around, the people quite attached to the idea of them, ultimately we should see a simplification of fund structures, because the benefit of the more complex dual structures just isn't there anymore. Do you think, Eddie?
Oh, definitely. So in terms of the structuring and the impact that's happening with the changes to remove agricultural assets from being able to qualify for the reduced withholding tax rates for managed investment trusts, you are right, we are seeing a simplification of the structures from the historical dual trust structures to a streamlined single trust structure. So on the administration side, that is simpler, but of course, on the flip side, the 15% tax rate that used to be available is now gone, and now it's back up to a 30% rate.
That's compressing yields, right?
Exactly, and whether that makes this type of investment as favourable as it was before, it does make it more difficult. So we are seeing that, while agri is something that they're interested in, if the tax rates now make it no longer as favourable in terms of overall return, in terms of yield, definitely seeing foreign investment just have a sort of second think about investing into agri funds.
Although I think then we're probably looking at juicing up the asset class a little bit. A couple of favourable tailwinds there. Ag tech is a specialist asset class. We act for some pretty exciting companies doing innovative things in ag, feeding cattle, seaweed to reduce their carbon emissions, other exciting developments. I think a slice of venture alongside your land exposure or your more traditional commodity exposure can juice up the returns. And I think carbon is the next, big frontier that the ag asset class is opening up to. I think there's definitely benefit to aggregator players in the carbon market or with a carbon spin. Individual farms it's a bit unfair to expect them to do their day jobs and run their business and hedge their currency and predict commodity movements and then as well trade carbon on top. These are busy people, and I think there's a real opening there, and the big carbon producers are definitely moving into this market as a way of meeting their decarbonisation targets.
Yeah, it's an interesting diversification play, and branching out from some of those more traditional land usage is to applying those sort of carbon production or carbon proponent solutions. I think on everybody's radar to see, how the emerging uses and use cases line up with investor appetite, and whether indeed that brings our own superannuation funds into this sector even more than previously, as to whether the net zero targets and objectives are met.
I just don't see this tailing off at all, Jon. I think the SFDR in the EU sends us pretty strong signals about what's coming this way. Approaches in the US vary widely between the blue states and the red states, where some are pro and some are anti, but the general trend is towards decarbonisation. I just don't think this is a theme that's going away at all.
On that note, I think we've got a very clear sense that ag is very much here to stay and is going to be developing and something that'll mean an increasingly more significant piece and will be even more important from a global investing perspective, including in the private capital investor space. So we might leave it there. Thank you very much, Emma and Eddie, for your terrific insights into the market, and we'll say goodbye until next time. So thanks again for joining us. Just a final note to say, if you are interested in this area, please do tune in for the next episode. You'll catch all the previous episodes on wherever you get your podcasts or vlogs, on your streaming services. In the meantime, if you've got any particular topics you'd like us to cover, please do reach out to the contact details in the notes to this episode, or myself, jon.ireland@dlapiper.com, and we'll look forward to seeing you next time. Thanks for joining us.